I'm going to go ahead and start broadcast so I can bring up my stuff here. A lot of instructors next year are wondering if they should live stream or not.
Gosh, yes.
I believe every class should be live streamed at least once a year. Oh, no, we're not on 13, we're on 14. I got a text from Cole. What did he say was wrong? He was sick or what? So,
It's easier to get over this blue on here then.
well, flu season lasts what, until about May? I think it's supposed to last about May. You're live streaming today. Hold on. We're giving everybody a couple of minutes. Come in, Haley. Haven't seen you in a month. A week.
That's a lot. I missed the last class.
Huh?
Before that, unfortunately.
Okay. Now you missed Tuesday, right?
Yeah.
So I haven't seen you in a week. Okay, we'll go ahead and start a few things here. On this PowerPoint, it's just telling you what you should learn in this chapter. Long-term borrowing or earnings per share. Now, if you borrow money, you're not selling stock. So earnings per share is bigger. All right? You have less shares. Now, why do you borrow from bonds and not just sell stock? If you borrow from bonds, like I say, you're not giving up ownership. There's less shareholders, less owners. Now, also, if you borrow from bonds, you can deduct the interest expense. But on stock, you cannot deduct dividends as an expense. Okay? Now, describe the characteristics and terminology of bonds payable. We're going to catch on to that as we go along. Describe and illustrate the accounting for bonds payable, which we'll do. Describe and illustrate installment notes. You know what that is with automobile, house, what have you. Other long-term liabilities, but it's usually just the two: notes, installment, bonds, what have you. And another ratio, times interest earned. So we'll look at that. So anyway, it's a hard chapter. If you don't have a textbook, that's why I encourage you to drop the course. You're not going to pass. You're going to waste your time if you don't have a textbook at this point in time, which is almost mid-semester. And we do need to have another test before mid-semester. Now, mid-semester, is that before spring break? All right. And then we've got next week before spring break, right? So we've got today and Tuesday on this chapter, maybe to have a test on Thursday. Maybe. But we got to see if we can do this chapter in 2 days or not. It's a tough chapter, even if I let you have notes. Here it just says corporation finance by using debt. That's accounts payable, but long-term debt is bonds and notes payable. And then, of course, equity is stock. We knew that. Now, the bond is an interest-bearing note. That's all it is. It's a promise to pay. Now, if any of you ever bought government bonds, usually you can buy $100 double E, Series double E, I think, US bonds. You could buy those bonds for, anyway, $50. If you kept them 7 years, you could cash them in for $100. So the interest was $50 on those. But those you could buy in $100 or $200. But we're talking about corporate bonds, and how much did I say every corporate bond is worth?
100,000.
Nope. Every corporate bond is worth how much? 1,000. Okay. So we're looking at $1,000 bond. Every bond is $1,000. So if you sold 10 bonds, how much money is that? 10,000. If you sold $50,000 worth of bonds, how many bonds is that?
50.
Okay, so that's the $1,000. So we'll clear that up out of the way. And it does require periodic interest payments with a face amount to be paid at maturity date. Now, bonds pay interest twice a year. That's every 6 months. So they're paying semi-annual interest. So if the bond is paying 6% annual, how much is it paying semi-annual? Now that's some characteristics of bonds as we go along. They pay semi-annual interest. Periodic semi-annual is what it should say. One of the main factors that influence the decision to issue debt is EPS. EPS is net income minus preferred dividends divided by the number of shares. You know, if you sell bonds and you don't sell stock, EPS will be higher. And we looked at EPS in this past chapter. Now, we don't have to know the ins and outs of some of these illustrations. Now, does these PowerPoints go along with your textbook? If you flip a page, what page would this chart be on? We're getting up to 56.
I can't see.
678.
Yeah, right.
That same chart, okay. So you got it in your book if that looks better to you. All right, assume that this corporation, $4 million company, is considering following plans to issue debt and equity. 1, just issue all common stock. 2, issue half preferred and half common. But 3, issue half bonds and then 1 million preferred, 1 million common. Earnings before interest and income taxes are $800,000. That's the earnings. The tax rate is 40%. Now, interest over here is going to, interest on these bonds is going to save you taxes. They're all issued at par or face. Bonds are issued at $10 par and $50 par, and bonds are issued for $1,000 face. Okay. All right. Now let's see what a couple calculations here might do. The effects. Earnings per share on plan 3 is bigger because you finance with bonds, half bonds. All right. Earnings per share here is bigger because you finance with half preferred. All right. But plan 1, all common stock, it's $1.20. So if you finance with bonds, the earnings per share goes up. That's the point they've made. That's the only point we need to know from that illustration.
Is that completely due to the fact of the taxes or not?
Yeah, well, the taxes, but less shares. Susan, just real quick, here you may have had 100,000 shares, but over here you only have 50,000 shares. So you have less shares when you finance with bonds, okay? Now, that's an advantage of a corporation. They can sell bonds, they can sell stock, okay? Now, what did Facebook do when they first went on the Dow? They sold stock, didn't they? Or Google or Amazon or any of those. And some of those you'd have made a lot of money had you invested the first week they went on the stock exchange. When earnings are strong, Plan 3 has the highest EPS. Now, if earnings are weak, Plans 1 and 2 might become more attractive. All right, to show you that illustration too, if earnings are weak, let's see, net income, and pay dividends preferred. Well, over here, you don't have a whole lot left after you pay dividends to preferred. So your EPS is only 30 cents a share. So when earnings are low, then Plan 1, all common stock worked better. You didn't have to pay preferred, you didn't have to pay interest to common. So again, that's just one point. I'm going to skip this for a minute. And I do want to drill this in again. The face amount of each bond called the principal is usually how much? 1,000. The interest on bonds are usually paid, usually semi-annual. Pick that middle one. They can be annual, they can be quarterly, but let's go with semi-annual. Well, it did say that, didn't it? Most bonds are semi-annual. And the contract is called a what? So a bond indenture is a what? It's a contract. And the contract for a bond is called a what? The bond indenture. Okay. And more characteristics. I don't like serial bonds, but anyway, when all bonds of an issue nature at the same time, they're called just term bonds. But if bonds mature over several dates, now you issued $1 million worth of bonds, you want a quarter of them to be doing 5 years and a quarter, 5 more, and a quarter, 5 more, and a quarter, 5 more. That's serial bonds. But I like bonds to be issued and mature all at the same time. Okay. And most corporations, when you buy bonds, that's the way they work. But they do sell serial bonds. When a corporation issues bonds, the proceeds received for the bonds depend on the face amount of the bond, the interest rate on the bond. Now, I told you that all bonds are 1,000. But if you looked at the Wall Street Journal today, or if you looked at a quote, General Motors bonds might be selling for 95. Now, how much would that bond sell for if they quoted it at 95? $950. That's the same as 95% of 1,000. Okay. Now, bonds go up and down in value depending on the interest rates on the market. Now, for example, if you had a $1,000 bond and it was paying 6%. Now, let's say the national interest rates went down to 4%. Do you have a good bond? If you got a bond paying 6% and the national interest rate's 4, do you have a good bond? Yes, you do. This is the bond rate, this is the market rate. If the bond rate is higher than the market rate, you will sell that bond at a premium. You may sell it for 105. So if we sold that bond for 105, what would we sell it for?
What?
If we sold our $1,000 bond, it was quoted at 105, what would we sell it for? $1,050. Now, when you cash that bond in, you only get back $1,000. So why'd you pay extra $50 for it? Because it's paying 6% interest, and you can only get 4. So keep those things in mind. And
Doesn't have to, absolutely makes no sense.
the what?
I said that makes absolutely no sense to me, but that's all right.
Well, now, Susan, just a minute. Let's say you've got this $1,000 bond. You got it.
Right, I paid $1,000.
Ford Motor, yeah, you paid 1,000, and it pays you 6% interest. Now, somebody's wanting to buy that bond from you. Now, you know you can only take your money and go out and get 4%. But you're getting 6% already. So you won't sell that bond for $1,000, but you may take $1,050. That gives you a $50 gain. Now, he won't make 6%. If he paid you an extra $50, he will not earn 6%, okay? The face amount and the interest rate on the bond are identified as the bond indenture. The interest rate to be paid on the face amount is called the contract rate. Now we look at, or coupon rate. Usually it's coupon rate. Whoever owns that bond, let's say on April the 1st, you got a coupon, you send it in that corporation, you get the interest. Whoever owns that bond gets the interest, okay? The market rate of interest, sometimes called the effective rate, is the rate determined from the sales, but we'll call it the market rate and we'll call it the coupon rate. Now, here is where bonds get a little more complicated. We'll have to practice. If we issue bonds, okay, these are all $1,000 bonds. If market is more than contract rate, all right, then the selling price is less than the face amount. Sold out of what? If the market price is what? All right, let's reverse that. Let's say Susan's bonds only pays 4%, but we could go out there and buy another bond, pay 6%. So Susan's going to have to sell her bond at a discount. She'll have to sell it for $960 instead of $1,000. Okay, so let's call it a discount. Now, if we sell it at par, it's sold at face, and par being the same thing. And then if it's sold at premium, which is the one we were talking about to begin with, if the market rate is less than the contract rate, then we're selling at a premium. And we'll have to learn how to deal with that as far as journal entries are concerned. All right, just reviewing those: face amount, discount, premium. All right, the price of a bond is quoted as a percentage of its face value. Now, what this bond is quoted at 98. Now, we reviewed that. We reviewed that even on Tuesday. 98 is 98%, isn't it? So 98% of 1,000 is 980. If they're quoted at 109, they'll be sold for 1,090. Okay, so that concept you should be getting down. Okay, so you got a sheet of paper to price around for attendance. We got about 50% today, I guess. One guy came in
March 1st.
late the other day. He didn't have a book, pencil, or paper. And then he walked out on his cell phone. He was walking down the hall with his cell phone. So, and he made a good grade on the first test. Anyway, the price of a bond is quoted as a percentage of the bond's face value. So we've covered that already. Discount premium must be amortized. Now this is where we get into some problems. Assume that on January 1st, Eastern Montana, whatever, issued the following bonds. We're going to issue bonds, face amount $100,000, contract rate is 12%, 5 years, semi-annual, market rate of interest 12%. We're going to sell those bonds at face. Now, without turning the page in your book, what are you going to debit cash for there, Jonathan? Just look up there and use common sense. What would you debit cash for? $100,000. Okay, in common sense, what would you credit for $100,000?
Oh, credit, bonds payable.
Right. Now, that's an easy first entry on bonds. Debit cash and credit bonds payable. If it's sold at face, okay? Now,
If you're selling
at face,
it at face value,
face or par,
that's selling.
yeah. Now, we're always selling bonds in this chapter. We're always the seller,
Oh, we always are.
yeah. And there's the entry that Jonathan gave you. All right, now how much interest is that paying? If it's paying 12% a year, it's paying 6% semi-annual. So what is 6% of 100,000? 6,000. You debit entry expense and you credit what? Cash. You do that every 6 months for 5 years. And we're assuming that this is the end of a fiscal year, so if you pay on June the 30th, December 31st, and there's no adjusting entry. Now, if this is between dates, you may have interest payable. But here, we're sending out 6 months worth of interest cash to bond holders. Now, when we pay off the bonds, it's easy. Well, we got 100,000, we credit bonds payable. So when we pay back 100,000, we debit bonds payable, don't we? We just reverse what we did at the beginning. January 1st, the first day of the year, a company issues $1,000, 6%, to pay semi-annual interest, blah, blah, journalized entry record the issuance of the bonds at face amount. Now, these are the same entries reviewed, debit cash, credit bonds payable. When you pay off, debit bonds payable, credit cash. Now, what is half of 6%? 3. What is 3% of a million? 30,000. All right. If you don't hack the interest rate, multiply by 1/2. If you want to multiply by the year rate, then multiply by 1/2, you still got 3%. Okay. So these generic entries should not get you down. There's harder things in this chapter to put more time on. Okay. Now, let's look at bonds issued at a discount. These entries, again, are not hard, but a method we use to amortize that discount, we're going to get rid of that discount or premium somewhere that gets a little rough. Face amount is 1,000, contract rate is 12%, but the market is paying 13. Now, those present value tables I showed you the other day, we can go in and calculate that discount by using those present value tables. We're not going to do it yet, but we could. And on a test, I'm not going to ask you to calculate the face of those bonds. There's 3 ways to find the face of those bonds. They flat out give it to you. Or they say decimal 98 and calculate the face. Or you can go to those 2 tables, present value tables, and find the present value of the bonds and the discount or premium, interest amount. Okay, we're going to sell these bonds at a discount. Okay. All right. So what do we do with the discount? Debit is. What do you think you would do if it's a premium? It'd be credit, wouldn't it? So premiums and discount. So now we didn't get 100,000 cash. We have to debit discount for the difference to equal 100,000 bonds payable. You're going to pay back 100,000 no matter what you take up here. All right, it's a contra account, as they tell you.
Did they figure out, did they tell you anywhere how they came to those numbers?
Well, how they came up with those?
Yeah, that's where I was lost, I guess.
All right, now, Susan, these bonds, first off, they gave you that number, right?
Yeah.
And many of your journal entries, the discount or premium will be given. But now what if they'd have quoted that at 96? You'd have multiplied 100,000 times 96, wouldn't you? And that would have been 96,000, Susan. Now this one would have been quoted at 96.406. That's how it would have been quoted on the Dow.
We didn't have to figure that out.
And you didn't have to figure it out because they gave it to you. Now, so Susan, here's one way you'll know if it's a discount or a premium. If it's below 100, it's a discount. If it's above 100, it's a premium, right? Now, I was just telling you that those two tables in the back of the book, I could have you calculate this. I could show you where they got this. Okay? And if we have enough time, I'll do that. If we don't, I'll skip it. But I can show you how they got the 96,406. But if they give it to you, it's better for you. All right. So on the first day of the fiscal year, a company issues $1 million, 6% bond, receiving cash of $936,000. Debit cash, credit, debit discount, just like that other entry. Every period or portion of the bond discount must be reduced and added to interest expense. So let's look at how much is this discount. I don't know which one they're using. I don't know which one they use. I'll wait till I get there. And amortization. All right, the entry to amortize a bond discount is as follows. The preceding entry may be made annually as an adjusted entry or may be combined with semi-annual entries. And the later case, the entry would be, usually this second entry is what we use. Most of your problems, your debit interest expense, and your credit cash for whatever you're paying out, and the difference will be discount. But how would it come about that? Now, first off, we're going to learn this method today. It's quite easy on the straight line method. Now, if your discount is $5,000 for 10 years, now remember, 10 years is how many periods? Usually 20 if we're paying semi-annual interest. So 2 times 10 is 20. So divide this 5,000 by 20, and what would you get? $250. And that would be your straight line amortization. But you won't get it until you're practicing. Now, the effective interest method, we'll look at that in a minute. Assume that amortization of Western Wyoming distributed bond discount of $3,594 is computed as follows. All right, you've got the $3,594. Term of bonds is 5 years. All right, your semi-annual interest is, now they're divided by how many periods? How many? 10. All right, here is your journal entry. Every time you pay interest, then there's your journal entry. Now, up to this point on the straight line method, let's go ahead and sell $100,000 worth of bonds. We'll stick with the discount. We're going to sell those for $96,000. All right. Obviously, what is the discount? 4. And we're going to go with 8% interest. And we're going to pay twice a year, semi. All right. Now, first off, I want you to take a scrap sheet of paper and make the journal entry to sell these bonds.
How many terms? Put in there.
Well, that's a good point. Let's say 5 years. All right, make that journal entry on a plain sheet of white paper. Okay, did that sheet ever get all the way around where I wanted to go? Everybody's name on it? Let's see, I think there's only 6 females in this class, 4 are present today, I guess. Lindsay, and I know Maya, and then there's, there's 12 males and 4 are present. Does that add up to you all? 4 females present out of 6, that's 2/3. But 4 males absent, present out of 12 males, that's 1/3. So today, females have 2/3 attendance and the males have 1/3. Okay. All right. So make this journal entry. All right, now, if you don't have it written down, please do so now. You're going to debit cash for how much? You're going to debit cash for $96,000. Well, you're going to debit for the 4. Well, you're going to debit for the 4.
4,000.
All right, and what are you going to credit for the 100? Here is your journal entry. Please jot down that journal entry. It's not the right amount. We debit cash for how much? And we debit discount for how much? And we credit bonds payable for how much? All right, now let's get that entry down. Okay. Now, let's go back to where we were. I had to go backwards there to show you that. Okay. Now,
What's the other one? What's the last one? I'm sorry. Right, it's best.
credit bonds payable for 100.
So this would be if we sold the bonds?
No, we're buying bond. The corporation's selling bonds, yes.
Okay, so that's.
We're always selling bonds in this chapter. Always. All right, now you're done the first entry. Now here's the second entry. Here is the second entry. So I want you to jot this down on a plain sheet of paper. Jot down the account. Don't put the amounts in yet. Jot these accounts down. You're going to debit interest expense, you're going to credit discount, and you're going to credit cash. All right, now how much interest?
Wait.
Okay, write that down. I'll give you a second. All right, if it's 8% a year, how much is your interest rate semi-annual?
$100,000.
Yeah, on 100. You do have to pay on 100. I'm sorry I gave 8% because you're going to get a number that might confuse you. You're going to get 4,000. So we're going to go back and change that to 10%. Doesn't matter, you haven't got anything written down yet anyway. All right, what is half of 10%? What is 5% of 100,000? How much? All right, credit cash for $5,000. That's what you're paying out every 6 months.
Is that interest expense?
No, you're crediting cash. Just cash right now. I've not given you anything for these two yet. All right. Now, before we can get interest expense, a discount adds on to interest expense. That's what it does. Now, how much is that discount? Was it 4,000? The discount was how much? How much?
4,000.
All right. Now, 5 years is how many periods? How much?
10.
10. Okay, divide 10 into 4,000. How much?
400.
All right, so credit 400 discount. Now, what is your real interest expense? You can make your debit now, 5,400. That's your debit to interest expense. Now, have you got your entry completed yet? What are you lacking, Susan?
Oh, maybe we have cash. And then we
You
just
should.
pay it. I just did.
Oh, you got it.
Yeah.
Oh, you don't have the number down here yet?
Yeah.
Okay. But that's walking you through interest for a bond sold at a discount. All right? When you study your chapter and do some homework, these will come okay to you. Now, bonds sold at a premium works the same way. But now, if you sell bonds at interest, a discount, it ups your real interest expense every period. If you sell at a premium, it decreases your real interest expense every period. Here it tells you, discount, amortize, increases interest expense. It makes everything come up to everybody's getting the same thing. All right, here you're issuing a bond at a discount. And here you're, this company's issuing these bonds. Now, we could take this 12% and this 11% and go to those tables and find out what they're going to sell this bond for. They sold 103,000. They're selling at a premium. So you will debit cash for the 103,000, but your bond payable is only 100. So the difference is a credit to a premium. Remember, a premium is like an income credit. A discount is like an expense debit.
Did we not just credit all that stuff? We just did. Didn't we credit $400?
Yeah, discount. Yeah. All right. That is when we pay the interest, Susan. Now, when we sell a bond at a premium, we'll debit cash, we'll credit bonds payable, we'll credit premium. But then we'll take this premium and then debit it. Yeah, we'll debit this premium when we pay the interest. All right, so make this entry. Let's sell $500,000 worth of bonds for 508,000. All right, make this entry with the figures I gave you. We need to practice. If you're watching this at home or if you watch it later, please practice what we're doing. Huh?
What's that bottom one?
That's really 10 years.
Okay.
All right, 500,000, selling for 508, 10%, 10-year bonds, paid interest, semi-annual, of course. Now, go ahead and make this journal entry. Write it down somewhere. Practice it, you can do it. Look at that. So you debit cash for how much? 500 and what? 8,000. Your credit bonds payable for how much? Only the face amount of 500,000. And your credit premium of how much? 8,000. Okay, now I want you to make this entry without me telling you anything else. On the first day of company issues, the pay semi-annual, blah, blah, and that same entry. I wish you make this entry. Here are your accounts. So make this entry with the information you have on that new bond. Remember, 10 years multiplied by 2 is 20 periods, right? Did I leave that at 10% interest? Did it. All right. Half of that is 5%. Okay, let's get some figures down. $8,000 is your premium divided by 20 periods, and I didn't mean for that to come out the same as the discount, but that's equal to how much amortization per? Is that 400? Okay.
Where'd you get the 8,000?
Huh?
Where did you get 8,000? Okay, that's.
I find that in your journal entry. Yeah, that's what we're amortizing. When I get to 20, I said there were 10-year bonds times 2. We got the 400 then, right? So we're going to put the 400 right here as a premium, aren't we? To amortize. Now we're going to pay 5% interest. That's semi-annual times $500,000 would be how much? Is that, how much interest are we paying? 5% of 500,000. How much is that? Is that 25,000?
Yeah.
All right, that's $25,000 interest. That's the cash we're going to pay. So let's credit cash for 25,000. Now to make that balance, what do I debit interest expense for? 20 what?
25.
No. Subtract.
Oh, subtract.
A premium reduces your interest expense. It reduces it from 25 to 24.6. A discount increases. Okay, I've never walked anybody through this chapter as slow as I'm going today. All right, so the what?
Don't make me feel stupid.
No, I'm trying to walk y'all through it slow. And this is we're still on not the hardest part. Okay, we have to move on. We looked at those, amortizing a premium. A corporate may redeem or call bonds before they mature. Callable bonds can be redeemed by issuing corporations. They usually redeem its bonds at a price different from the carrying amount. So a gain or loss may happen. Now, redeeming bonds. Now, corporations, if they were paying 6% and the market rate went down to 4%, they may call in their bonds, pay those bondholders off and issue more bonds. All right, there's not much in the chapter about this, but you need to see actually though how it works when a bond's called. All right, assume June the 30th, 2005, a corporation has a falling bond. Boy, they're way behind here. Maybe it's 25. A corporation has a bond issued. Now they sold bonds in a phase. They have a premium. After semi-annual interest payments and premium amortized have been recorded. Now, you sold those bonds for $96,000. No, wait a minute. You sold them for $104,000, didn't you? Okay, but we got to calculate how many interest periods have went by. Assume that on June the 30th, they redeemed 1/4 of the bond. That'd be $25,000. In the market for $24,000. Right, they're going to pay cash for $24,000. They got a debit bonds payable of $25,000. Those two figures you can clearly see, but this is the unamortized premium on those bonds, or the premium, which was $1,000, and then you got a gain of $2,000 on selling those bonds. That's just the difference between debits and credits. Okay. Now, $1,000, if there was $4,000 on $100,000 worth of bonds, 25% of 1/4 is the $1,000 for the premium. So that's redeeming bonds. And then you could issue more if you want to. Now they're going to pay cash of $79,500 for the rest of the bonds. Bonds payable $75,000. Now that $4,000, $3,000. And in this case, you paid more for them than what you got total, and you've got a loss of $1,500. So you can have a loss or a gain on redeeming bonds. Let's look at an installment for a moment. Now, there's all kinds of credit. There's all kinds of credit. Someone may have 30-day credit. You may have to charge account down to local corner market or station. You get 90-day credit on furniture. Installment credit is usually on what? Does anybody owe car payments? Who owes car payments? That's installment. You pay monthly installments for 3, 4, 5, 6, 7 years, whatever. Okay. A mortgage payment is still installments and so forth. But now, how many of you have a credit card? Who has a credit card? Do you pay it off money every month? Susan, you keep yours paid off every month?
I answer that.
Oh, okay. I would encourage anybody that uses a credit card because pay it off every month. That way, if you're not paying any credit card fee, you're just using their money a month or something like that for free. And that's how they make their money. Not only do they charge the retail from 1 to 5% of that sale, and they charge you up to 20-some% interest. And that's how they make the money. Okay. I meant they have to make money, but they're not going to make it off me. I'll pay them off at the end of every month. I will not pay them interest or late charges. Late charges is a waste of money too. It's like a traffic ticket. It's a waste of money. Okay. All right. But now, in every situation, people can't pay off everything. So on, there are exceptions. All right, the installment is just payments. Okay. At the end of the note's term, the principal will have been repaid in full. Installment notes are often used to purchase assets such as equipment. All right. When a note is secured by an asset, it's called a mortgage note. If it's secured by an asset, now Monique has her car on installment method. If she don't pay for that car, what happens to that car? Goes to the bank, don't it, or whoever. So it's a secured note. Her car stands good for the rest of that note. And hopefully, if she lost her car, its value would be more than what she owed on it. But now, if the bank repoed her car and she owed $6,000 on it, and they could only sell it for $5,000, what happens to the other $1,000? Monique still has to pay it, don't she? So it's hard to pay $1,000 on a car that the bank already took. Don't ever get in that trap either, if you can help it. Assume that Lewis Company issues the following installment note. Now, $24,000, the interest rate is 6%, it's for 5 years, and the annual payments is $56.98. Now, the entry to record the issuance of the note is debit 24 and a credit of 24. All right, is that a long-term note or a short-term note? Term of the note is 5 years. Anything over a year is long-term, isn't it? All right, but now 1 year may be, all right, the amount of the annual payment is calculated by using the present value concepts discussed in Appendix 1. The annual payment of $56.98 is computed by following the $24,000 loan amount by the present value of an annuity for 5 periods at 6%. All right, go to your appendix real quick on Appendix 1.
It's like still in this chapter. So not probably.
There's some of it in this chapter, but I don't know, if it has the right number of years, period, but it's in a couple of pages over here. What page is it on, Susan?
Appendix 1 is on just a couple pages back. 693.
693. All right, do you go to table 1? Well, that's what you should be on. Now, annual 6%, that's what you look at for how many periods? Now, go down to that decimal for 6% for 5 periods. All right, did that give you 4.21236?
No.
No, it couldn't be a 4, could it? All right, let's see. The annual payment of $56.98 is computed by dividing the $24,000 loan amount by the present value of an annuity of 1. We had to go to the annuity table, which is the second table. Sorry about that. Your multiplier has to be bigger than 1. Present value of lump sum, your multiplier is less than 1. So now, what page is that on, Susan?
Next page, 696.
All right, now go down to 6%. Anytime you're making a payment, it's called an annuity, and you use the annuity table. All right, now go down 6% for 5 years. What's your decimal? 4.2? All right, now divide that into 24,000. Divide it into 24,000. Round to the nearest dollar.
I got 5,698.
5,698. That's what you should. But I'm just leading you through how you calculate the payment on installment plan. That's how the bank calculates your mortgage payments every month. And then every month, you know, your principal is paid more and your interest less as the months go by. Okay, let's look at the journal entry on this. Definitely, when you borrow it, you debit cash, you credit notes payable.
Borrowing or
We're borrowing. Now, you can construct this table. All right? You found this, didn't you? Now, column A, you start off with 24. You get this payment. But your interest expense is 6% of the carrying amount. 6% of January 1st carrying amount. All right, so that's 6% of 24,000, right? Now, a decrease in your notes payable. You're paying 14.4 in interest, and the rest of this is principal. And if this is principal, all right, take A minus D, and you get the remainder that you owe. In other words, the payoff. You've heard of payoff. I want to pay off for my car. I want to pay off for whatever. The payoff in this year would be only 50-some hundred. So what is your payoff? Now, here's what I'm concerned with right here. Oh boy. Can't draw a line in the first place. My pen's not working in a second. But look at that first item up there. When you make a journal entry, can you make a journal entry for these things? Let's write down interest expense, $44.40. Let's make an entry on plain sheet of paper. Write down interest expense, $44.40.
Debiting or credit? Debiting.
Wait a minute. I'm trying to think of who we are here. Are we the issuer? It's notes payable, wasn't it?
Yeah.
We're the borrower, right? So we would have to credit cash for this payment. Credit cash for $56.98.
Begin with,
Huh?
it's the first thing.
Well, credit cash, but leave room to put two debits. All right, you know you got to credit cash if you're paying this amount every month on your note. Okay, now what's this table for? Now, debit interest expense for how much? $14.40. And debit the difference, notes payable. You have actually paid off $42.58 of your notes payable.
I got lost because I thought I was supposed to do interest expense first.
All right, let's start it from the top. Let's make a journal entry. Let's debit interest expense for what it says it is.
Okay, so the first thing we do is debit interest expense.
Yes. Debit interest expense.
56.
$14.40, what it says. Now debit bonds payable for the $42.58. When debit bonds payable. And you credit cash for the payment.
$42.50.
All right, we're going to do, let's don't worry about that too much yet, Susan. You can look at it in the book. I'll probably show it to you right there, Susan. That's what I wanted you to write down. Whereas your debit interest expense and your debit notes payable and your credit cash. All right. But I want you to try a problem, okay? you're going to borrow $50,000 for 10 years when the going rate of interest is 8%. Now I want you to calculate your payments. See if you can calculate the payments on $50,000 for 10 years at 8%. You went to the annuity table and you found the 10 years at 8%, remember? If you followed me on this example up here somewhere,
No 8%.
so no 8%, what percent?
That's compound interest. No, there's no 8%.
What percents are given then, Susan?
4, 4.5, 5, 5.5, 6, 6.5, 7, 10, 11, 12, and 13.
All right. There would be 8% in the back of your book, but let's make it simple for you and change this to 10% interest. So it will be in the body of your chapter. All right, now, Jonathan, when you go to that annuity table, you find 10 years for 10%. What is your decimal?
6.14457.
That
2 fours.
6.14457. All right, you got to use the whole thing. Now divide that into 50,000. Divide that decimal into 50,000. What would your payments be? 8,000.
137.
Rounded to the nearest dollar. That would be our payments, okay? That would be our payments, $8,137 a month. All right, you've got some pretty good examples in your book, so please follow those. Bonds payable, notes payable, long-term or on the balance sheet as long-term liabilities. So look at this new balance sheet real quick. No biggie to you. There's current liabilities, a bunch of them. There's long-term liabilities, notes and bonds. So that's your balance sheet. We don't show the assets. We don't show the equity. This is just the liabilities on a balance sheet. So that's not a hard concept. Now, look at this formula. Of course, you're going to have that copied down in your notes for the test. Times interest earned is income before taxes plus interest and over interest expense. So here is really the formula for that. You may not like it, but all right, earnings before interest and taxes. That's the formula, the true formula for that. Earnings before interest and taxes. Income is earnings before interest and taxes. Okay, that's your formula. Earnings before interest and taxes divided by interest. Okay. You can have that written down for test purposes. All right, now we will look at Appendix 1. I want you to read that. And that's where we will have to amortize that interest by, we'll have to amortize the interest by the effective interest method. So please look at that chapter. Now, let's go to Your first exercise due today. I asked you to work the first how many? 3. Chapter 14, exercise 3. All right, those were just questions, so let's make pretty quick do with them, get rid of them, whatever you want to call it. Effective financing on earnings per share. We looked at that, and we know that usually if you finance with more bonds, your earnings per share goes up. That's all I want to say about exercise 1. Exercise 2. Based on the data in exercise 14.1, what factors other than EPS should be considered in evaluating these methods? I told you that too. Don't know if you picked it up, but there's less stockholders, there's less voters, there's more control for a few people. Now, if 10 people own a corporation, you got 10 votes. If each one of them have only one share of common stock apiece, that have 10 votes. But if you sold 15 more shares, that'd be 25 votes, wouldn't it? Now 25 people has to vote on something for the company.
Common shares, they get to vote on it.
Common shares do, preferred do not.
Oh, the opposite. Okay.
All right, evaluate alternative methods. 3, corporate financing. Financial statements for Nike are presented in Appendix D at the end of the next text. What is the major source of financing for Nike? Well, let's turn over to the Appendix D. Turn over to Appendix D and let's look at Nike. All right, look at their balance sheet. What page is their balance sheet on? Keep going, see the consolidated statements. That statement of income, cash flow. Balance sheet is on page D4. All right. John, you have on Nike, don't you? Okay. All right. So anyway, it's a real company making real products, and Jonathan is giving them some business. Okay. All right. Now look at it. Are they using more bonds or more stock? Susie, your page looks a lot different than John.
Is it page 4? D4?
D6.
6, page 6. Page 6, appendix what? D. All right, let me see, Jonathan. I hate to turn my little sleeve book up there. All right, now they've got total assets, current liabilities, now equity. They've got long-term debt. Oh boy, let's see. Long-term debt of about $6 billion in 1 year and $5 million in another. All right, now equity. Just a minute.
I see current liabilities like that. Long-term debt is 2010.
They got Class B stock, 7. They are financing, the way it looks, with a whole lot of debt, about 40% debt and about 60% stock. All right, look at their common stock and look at the long-term debt. The long-term debt may be bonds, but that's what they want you to look at. Okay, so real companies use real accounting, okay? And let's give you some assignments for Tuesday and get you out of here today. So for Tuesday, I'll write these down for you in a minute. I want you to do exercise 5, interest for issued bonds. I want you to do exercise 6, amortize that premium. Discount. Now do exercise 7, amortize the premium.
Do that.
All right, I'll write them down. I've already asked you to do exercise 5, 6, 7. All right, but I'm not finished. I want you to do exercise 8 for calling in bonds. And exercise 11 for installments. All right, that takes care of some of the major concepts in the chapter: issuing bonds, discount, premium, and installments, and call them in. Now, that takes care of the major points. So please work these exercises. I will give you problems to work for next Thursday. So we probably won't be able to have a test, okay, next Thursday. So the only grade you've got for midterm is the one test. So I will have to turn in some D's and F's. Sorry about that. But that's the only grade you've got. We will not be able to do another grade or test. So don't worry about the midterm, worry about the final grade. That's what stays with you. Okay, midterm don't stay with you. Okay, have a good week.